All right, well, the NBA put out its weekly mortgage application numbers just about 40 minutes ago. They came out with a drop of 2.2% week over week, second drop in a row, although a couple weeks ago the numbers looked pretty good. So how do we read it? Well, Bob Moulton is president of Americana Mortgage Group. They are a mortgage broker in Manhasset, New York, which you're not familiar with, is a very pricey piece of real estate around here, and we appreciate you joining us, Bob. Listen, 2 weeks ago, the numbers have been in a downtrend, but 2 weeks ago, we had very big numbers. I think it was 11% up on the purchase money side, even higher for refis. What are you seeing as a trend?
Well, we're seeing an overall downward trend. And every once in a while, when mortgage rates drop, you'll see a lot of homeowners who have adjustable rate mortgages that they're anticipating to refinance because they're staying in the houses longer than they originally anticipated. When the numbers were escalating at double-digit numbers and everyone was jumping into the real estate market, they figured they were going to be in the house for a short period of time or flip the house, took out a 3-year arm or a 5-year arm. So when you see that 10-year note drop to 4.5, 4.6, mortgage rates come down, everyone's going to jump into refinance because they're not staying there for 3 years or 5 years. They're going to stay there for a longer period of time. The overall trend is down right now.
Okay, are they refining into other adjustable rate products?
They're actually refinancing into more longer-term products because with a 30-year fix, only 100 basis points higher than where it was 3 years ago at the all-time low. They're actually refinancing into higher rates, knowing they're going to pay a higher monthly number, but knowing that long-term it's more of an insurance for them to take a fixed rate right now than go into another adjustable rate.
So it appears that maybe psychologically they're sort of committing to stay then. And not maybe flip that house like you talked about.
Well, right now we have a very flat yield curve, and the spread between the adjustable rates and the long-term fixed rates is not that great. So psychologically,
an arm's not giving you a huge benefit right now, is it?
You're not getting a great benefit, Brian, on an arm, on a 3-year or a 5-year. There might be a 25 basis point savings, maybe a 50 basis point savings, but overall, the fixed rate numbers have been a lot more favorable than originally anticipated probably about a year ago.
You know, 2 weeks ago, like I said, when that number came out very strong, and I did a panel, I was gone last week, I was out in L.A., and I did a panel with Angela Mozzillo, the CEO of Countrywide, the biggest mortgage lender, and we talked about that big number. At this point, it was 1 week ago, and I said, you know, why was that number so hot? And he said, well, because mortgage rates had come down. I said, is it that sensitive? I mean, are people like that sensitive to 30 to 50 basis points a move? What are you seeing?
Well, right now, everyone watches interest rates like they watch their favorite baseball team.
They do. Is it that closely?
It's that closely. And even customers who may not have been as educated as some of your more financially savvy customers are very familiar with how the markets fluctuate right now. So a lot of customers, and I like to educate them as well, and tell them to watch the 10-year note because as that number comes down, your 30-year mortgage is going to come down or your adjustable rates mortgage is going to come down. So a lot of people do focus on that. And when that number hits, the throttle opens up and they're going to put those refinance applications in a lot quicker than later.
Mozzillo suggested in the panel that 6% was kind of a magic number for longer-term mortgages. Do you agree with that? I mean, people see 6 or below and they think, oh, let's refi.
Well, 5% was a great number, 5.5%. 6%
is a beautiful number. So if you give me a 30-year at 2%, I'm in, Bob.
Okay, I'll put you on my list. But 7% is a psychologically devastating number, and I think people really back off when they see 7%. But with the Fed raising rates 17 times in the last 3 years or so, the perception was that long-term mortgage rates got significantly higher. In fact, they have not. We have an inverted situation right now where your home equity lines of credit are costing you approximately 8.25%, and your long-term mortgages are about 200 basis points cheaper. So you have a lot of clients refinancing out of those into the first mortgages when they see those numbers dip.
I assume that you also can follow prices. I mean, based just on what people are borrowing, correct? And what are price trends doing?
Price trends are getting a little soft. We're seeing homes out there for a longer period of time. Sellers still have that mentality that they can get the price that they could get a year ago, 2 years ago. There's a little stickiness there, particularly in some of the more local markets in the New York area where the sellers are holding on to that price that they thought they could get a couple years ago. Inventories are swelling, and there's that stalemate situation where the buyers don't want to come up because they think there's a real estate bubble and the sellers don't want to come down. I think that's got to shake out in the next 6 to 12 months.
Are you seeing people take fewer of the, you know, I hate to editorialize and call them risky, but let's say the really exotic instruments like the pay option arms?
Not so much the pay option arms, but more the interest-only products because they are a little safer. The payment on an interest-only mortgage, Brian, is about 30% lower than a traditional mortgage. If you're bonus-driven or commission-driven,
which a lot of Wall Streeters are.
Which is a lot of Wall
but
Streeters
not middle
are.
America. I mean, if you're a Wall Streeter and you make, X amount of dollars but have a gigantic bonus, interest only is great for you.
it's a great product for that person.
But the rest of America
is more of a traditional product, not necessarily an option arm or an interest only, but they would be looking more for your 15-year fix or your 30-year fixed product.
All right, good stuff. Bob Moulton, president of Americana Mortgage. We appreciate it, Bob.
Thanks, Brian.
Thanks very much.